Hi, everyone. Welcome to today's webinar, which is part of the Young Scholars webinar series on climate change, macroeconomics and finance, organized by the E-Access Forum. My name is Alisa Klein-Nijenhuis. I'm one of the co-organizers of the webinar, and I'm at Cornell University. And today we have the pleasure of having with us Parinitha Sastry, who will present her paper entitled Business as Usual, Bank Climate Commitments, Lending and Engagement, which is co-authored with D. Marquez Ibanez and Emil Werner. So Parinitha Sastry is currently an assistant professor of finance at the Columbia Business School. Her research is at the intersection of climate finance, financial intermediation, and real estate. Prior to beginning her academic position, she spent a year at the Department of the Treasury as a climate finance postdoctoral fellow, and she received her PhD in finance from MIT and her BA in economics and mathematics from Columbia University. Prior to her PhD, she worked at the Federal Reserve Bank of New York, the Brookings Institution, and the Task Force for Climate-Related Financial Disclosures. So welcome again, everyone, to this E-Access webinar. We will reserve around 15 minutes at the end of this hour for a Q&A. So if you would like to ask questions, please use the Q&A function at the bottom of the screen to pose your questions. And if Pari allows, you might also put up your hand in between if you want to ask some clarifying questions during her talk. So enjoy the talk, and without further ado, Pari, the floor is yours. We're very excited to hear about your research.
Thank you so much, Alyssa. And yes, I'm more than happy to take questions during the talk as well as after. So if I miss a hand raise, just maybe bring it to my attention, Alyssa, if you don't mind. But I'll try to monitor that myself. So let me share my screen, and can everyone see my slides?
Yes, we can see it.
Perfect. All right. This is a joint paper, as Alyssa said, with David at the European Central Bank and Emil Werner at Sloan. The usual disclaimer applies. This represents our views and not the views of the European Central Bank. All right. So in terms of motivations, there's increasing pressure across the world to decarbonize the global economy. And as part of this pressure, we've seen unprecedented changes in public policy that aim at this goal. In Europe, we have had a carbon tax for a long time, but we've also had a scale up in green subsidies and other associated policies. In the United States, we've obviously had the passage of the Inflation Reduction Act. Europe, the United States, India, and China have all set explicit net zero goals with plans for achieving those goals. But despite these unprecedented changes in public policy, there are large challenges that remain. And the one that is often discussed in policy circles is this $9 trillion annual financing gap for green finance. So there's a belief in the broader kind of public square that there's too much financing of fossil fuels and too little financing of climate solutions or renewables or kind of green investments that are important and will be necessary if the global economy is going to meet its decarbonization goals. So in the context of this debate, a lot of people are optimistic and they point to these explicit net zero commitments made by global banks. So 133 global banks representing over 40% of global banking assets, or in terms of numbers, $66 trillion in assets, have made explicit net zero commitments. So a lot of these optimists say, well, you shouldn't be so worried about this global financing gap because we have banks that are stepping up to the plate and that are willing to scale up their financing. So the motivation for this paper is, can we actually look at the data and say something about whether these net zero commitments are leading to changes in bank behavior and whether these net zero commitments are going to lead those banks that have made these commitments to fill this global financing gap? And there's large public disagreement about this. There are some that are very optimistic, like what I said. You know, I have a quote here from Reuters where she says, Dr. Adriana Corsonek-Mina says the world cannot afford banks to step back from their net zero commitments. On the other hand, we have people from the Sierra Club that are saying banks are using net zero goals as a smokescreen to greenwash and just secretly finance fossil fuels. And then we have the chairman of HSBC that says, we're not going to divest from fossil fuels, but that doesn't mean we can't scale up green financing. So there's a lot of different opinions out there about what these net zero commitments actually mean. And there's been a push in the United States, at least, to try to acknowledge that these net zero commitments on its face may not be so credible, and there may be a need for policy action from regulators or Treasury that help to make these commitments more credible. And so what we're going to do in this paper is we're going to use two new administrative data sets from the European Central Bank. The first is going to be a global data set at the sector level. So we'll know for each European bank the total amount of, for example, mining loans they've made globally. And the second is going to be a within Euro area bank firm credit registry. So for all European borrowers and all European banks, we're going to have the credit registry, but we will not have the credit registry for global firms. And we're going to use these data sets to study the Net Zero Banking Alliance. So these are the net zero commitments that banks have made. It's the largest alliance globally. And as part of this alliance, lenders are actually going to they are going to declare sectors that they are particularly targeting for reducing financed emissions. So I know that's a little bit unclear. I'll be a lot more explicit about what these targeted sectors are in a few slides. So we're going to see how bank behavior changes in terms of their lending to their targeted sectors. We're also going to use a European regulation that the EU taxonomy, which is a regulatory definition of green sectors. And we're going to also use explicit data on green project finance. So we're going to look at the explicit financing of renewables generation. So with all of this administrative data, we obtain the following two key findings. So we basically reject any divestment happening by lenders. So we see no evidence that net zero banks are reallocating away from brown sectors towards green sectors. We show this on the intensive margin when you look at overall credit flows. We can also look at the extensive margin, looking at the entry and exit from different relationships. And we can also look at interest rates and loan pricing. We also look within sectors, so within the project finance sector for power generation, we see no reallocation towards renewables versus coal. So we have across the board a variety of specifications that push against the idea that lenders are divesting. We also find limited evidence that lenders are engaging. So we see that borrowers who are linked to net zero banks are no more likely to set their own decarbonization targets, nor do they reduce their own verified EU ETS carbon emissions. And so taken together, these results suggest that there are limited effects of these net zero pledges on bank financing. And at least the current evidence suggests that these net zero banks are not going to be the ones that help to fill the global financing gap. At least that's what the early evidence indicates. So in terms of the literature, I'm going to go through this a bit fast because of time, but we're obviously not the only paper that studies lender divestment and real effects on borrowers. There are now a few different papers that have looked at this question. But just in terms of our relative contribution to this large literature, we're going to focus specifically on these net zero commitments because they're linked with the commitments that are made by countries. So countries have net zero commitments and banks have net zero commitments. So it seems like the right commitment to study if we're going to understand whether overall countries are on track to meeting their net zero commitments. And unlike some of these other papers which use publicly available data, such as deal scan data on syndicated lending, in our administrative data, we don't find any differential effects. And so we think our data is we're bringing the best available data to the table, and it helps us circumvent some of the other well-known issues that come from using syndicated loans data, including the limited coverage and bias towards larger firms. There's also this literature on shareholder engagement and divestment with a large literature on trying to understand which approach is better if you want to actually have real effects on financial market outcomes. And so we're going to contribute that literature. We're not going to take a stand on whether engagement is a better strategy than divestment. We're going to look at both. And we're going to measure both divestment and engagement. And we find limited evidence that either is really happening in this space. And then there's obviously this old literature on the bank lending channel and credit supply shocks. This literature suggests that if lenders were to meaningfully reduce credit supply, this is different from divestment in, for example, equity markets or other markets, which are a lot more competitive. And so some credit supply shocks could have real effects, but of course we find no evidence of any credit supply shocks. So our contribution to that is just by looking at some of the bank lending channel regressions. So in terms of the roadmap, we're going to have a few different parts of the paper. I'm going to describe the data and some institutional details about these net zero commitments. I'll present some novel descriptive facts about these commitments, and then I'll go into the details of how we're going to try to measure divestment and engagement using this triple difference in differences design. Then I'll show you the results and I'll conclude. All right, so there are these two administrative data sources that we're going to bring to bear for this project. The first is this European bank global lending by sector. So for 330 banks, we have their sectoral lending from 2018 to 2023. So to be clear, we're not going to be able to differentiate within a sector, and a sector is a pretty broad classification. It's going to be by NACE letter. So we're going to be able to look at trends worldwide, but we're not going to be able to say anything on kind of a more granular basis than sector. So we supplement this sectoral level global data with the honor credit data, which is a bank firm credit registry of lending within the Euro area. So this is going to be administrative data within the Euro area, but of course it's going to miss anything that's happening outside of the Euro area. So this data set is going to be lending by these same 330 banks to about 700,000 firms. And it's also available, it's actually available on a monthly basis. We're going to look at it on an annual basis because of the sheer size of the data. So we're going to select our sample in the following way. We're going to aggregate up to the parent bank level using an ECB group structure. So all banking subsidiaries will be rolled up to the banking parent. We're going to limit our data to banks with consistent data reporting. And we're going to limit the borrowers to non-financial firms. So we're not going to be looking at interbank lending or anything along those lines. And so we're going to think about whether a bank is green or not by looking at whether they join the Net Zero Banking Alliance. So as I mentioned, the Net Zero Banking Alliance covers about 40% of global banking assets. They have 138 banks across 44 countries. And they're, oh, I think I said the wrong number earlier. Sorry, it's $74 trillion in assets, not 66. But they have a huge share, global market share. And the actual commitment itself is a commitment to reduce finance emissions in line with the 1.5 degree trajectory. And so the idea here is that every single country has made its own net zero pledge as part of the 2015 Global Paris Agreement. And if your country has a particular emissions trajectory, you have to think about how your bank lending is going to be consistent with your country's trajectory. So that's how the net zero commitments are structured. And as part of this, we're going to need, the banks are going to need to set sectoral targets for decarbonization. So what does this mean? So the Net Zero Banking Alliance Secretariat says that you have to say you're going to reduce financed emissions in particular sectors by 2050. And these sectors have to be the most greenhouse gas intensive ones in your portfolio. So if I have 90% of my lending to oil and gas and 10% of my lending to textiles, I can't have a target in textiles and not have one in oil and gas. So there's these rules on target settings. And there has to be a long-term emissions reduction target in 2050, but you can't just kick the can down the road. You have to set a target starting in 2030 for every 5 years after. So the idea of these rules is that, you can't just have some random target for 25 years from now and not be accountable for any period before then. So you have to start your target setting in 2030. And there's a United Nations Secretariat that is monitoring the net zero plans of these banks. So these aren't just sort of requirements that are not monitored. Then the UN Secretariat is checking whether the net zero banks are setting targets when they're supposed to, and if the targets are sort of ambitious enough. So we use the data from the Net Zero Banking Alliance website to get the list of members, the dates that they signed, and which sectors they've chosen to target. So as an example, here's a set of sectoral targets from Deutsche Bank. They have net zero targets in 4 sectors. They have a target in oil and gas, power generation, transport. They call it automotive, but we standardize it to say transport and then steel. And they say something specific. They're going to try to reduce by 23% their scope 3 upstream financed emissions by 2030, and then they have a 90% reduction by 2050. And this is relative to their 2019 baseline. They say it elsewhere. So we're going to look at every single net zero bank and get all of their sectoral targets in this way. We're going to then so that's how we classify banks. We're going to then think about how we're going to classify firms. So we want to know how bank lending behavior is changing. So obviously there's a definition that's used in the literature, which is coal, oil, gas, and metals, the mining sector. This is because this represents the majority of global emissions. So that's the first definition we're going to use. The second definition we're going to use is targeted sectors, the bank's own sectoral targets. And the idea here is that if we were to see divestment from any sector, it's going to be a sector that the bank has actually indicated that it wants to decarbonize. So that's kind of the motivation for the second measure. The third measure is going to come from the EU taxonomy. So this is a regulatory EU classification system. They have a list of the list of the NACE codes that they define as being sustainable and consistent with the European Union net zero goals. So it's passed as part of the European Green Deal, and we're going to take it off the shelf. So now I'll talk about some of the descriptive facts. So the majority of the net zero banks in our sample joined at the time the alliance was created in 2021, but we have some staggered adoption. So we have some banks that joined later. On average, about 10 banks have not set a target at all, and those were the late joiners that have some time to set targets. But conditional on setting a target, most banks have between 2, 3, or 4 targets. And in terms of which sectors are actually targeting, we are surprised. The majority of targets are set in power generation. So they have targets to decarbonize power. And then the next, the big three are power generation, transport, and oil and gas. So we think this is important because a lot of the existing literature on this topic have looked specifically at coal mining, but we actually don't see the majority of banks setting targets in coal mining. So we want to make the point that it's important to look at what banks are themselves saying they want to decarbonize to benchmark whether banks are actually divesting or not. And so then we're going to show some descriptive facts about which banks joined the alliance. So it's if you look at total size, the biggest banks are the ones that are making a net zero commitment, and it's not even close. We see that on average, they lend more to mining firms and less to the EU taxonomy firms. They marginally rely less on deposits, and they have higher net interest margins. So all in all of these sort of stylized facts come together, and we can say that it's the bigger banks with more brown lending that rely less on deposits. So this is going to tell us that there's a lot of selection into who makes a commitment, and we're going to need to think deeply about the selection when we try to identify credit supply. So now we're going to do some really descriptive regressions to try to understand a little bit about what these net zero commitments are representing. So the first is we wanted to double check that the sectoral targets are meaningful. So here we're just going to regress portfolio lending shares by a particular bank in a particular sector on whether they have a sectoral target in that sector. And we're going to have a bank fixed effect when we have the outcome variable being total lending rather than lending share. So what does this tell us? We're seeing that on average, the net zero banks are setting targets in the sectors that they have more ex ante lending exposure to. So these are actually meaningful sectoral targets. These represent the majority of their portfolio. And that's true both on a portfolio share basis as well as on a total volume of lending basis. And then we had the thought, what are lenders going to actually disclose as part of their net zero compliance reports? So they're not going to do any kind of sophisticated causal analysis. They're just going to show how much their lending has changed before and after they joined the alliance. And so what we're doing here is we're just regressing their lending on a dummy for after they joined the alliance. And we're going to look at their lending on the intensive margin. So they're going to try to say something about how they lend less to the firms that they've targeted, and indeed that's what they find. So on average, they reduce lending to firms in the firms in the targeted sectors by about 20%. And that holds even when you do it as a diff and diff. So when you do it relative to firms that are non-targeted, that diff and diff shows that they've reduced lending to firms in the targeted sector by 13% relative to other types of firms. We also find that the results go through when you look at lending relationships. So if you look at their net zero reports or you look at the monitoring of this, the net zero banks look really good. They look like they're complying with their goals. They seem to be actually reducing credit. But what we want to know is whether this is a causal effect of joining the alliance or whether they would have reduced credit anyway, regardless of whether they make these explicit commitments. So for that, we're going to need an identification strategy. The last bit is we're going to look at mining lending because we can do this looking globally. And you can see here that net zero banks do the majority of lending to mining firms globally. So about 20% of their global portfolios is going to mining firms. And there's no differential trends between net zero banks and and banks that have not made a net zero commitment. This is true if you look at portfolio shares, and this is true if you look at total lending. So just this descriptive result sort of may suggest that we're not really seeing causal effects coming from the net zero banking alliance. The last piece is if you look at where they're actually lending the most, you see that lending to mining firms in the United States and Europe is actually relatively small. The majority of lending to mining firms is happening outside of the United States and the Euro area, and in fact, outside of the OECD. So European banks are lending about 30 billion euros per year outside of the European Union and the OECD. And so this is one of the main reasons we think that the results in the syndicated lending data, the DealScan data, is not really capturing the true effects. DealScan is going to be skewed towards the Euro area and the United States, and the majority of fossil fuel lending is happening outside of those areas. And so having this global coverage is important when we want to understand banks' footprints in fossil fuels. We also show that they gain concrete benefits from joining the Net Zero Banking Alliance. So we look at their ESG ratings and we just see the ESG ratings of net zero banks skyrocket after they join the alliance. And on average, their ESG ratings increase by about half a notch after they join. So I know I gave a lot of descriptive facts. I'm going to pull them all together right now. I think it's important to look at these because we do see that overall lending to the mining sector has declined. We don't see, even just looking at the eyeballing of the chart, we don't see any differential decline by NZBA banks relative to non-NZBA banks. And we are seeing this important result that the majority of lending to mining firms is happening outside of the United States, Europe, and the OECD. So we learn a lot from just looking at these broad trends. But of course, what we can't say is something really specific about the causal effect of the Net Zero Banking Alliance. Sector is not granular enough. There may be reallocation within industry, within a sector, between industries within a sector or between firms within a sector. So we're going to now turn from this data to the European Bank Firm Credit Registry to examine these causal effects more closely. So we can look at different firms in the same sector. We're going to look at entry and exit of relationships, and we're going to be able to say something about engagement. So the way we're going to try to think about causal effects is by using a triple difference in differences design. So here we're going to regress our lending outcome. Let's say the euros portfolio share euros led to by a specific bank to a specific firm in a specific period. We're going to have bank time, bank firm, and firm time fixed effects. And the key coefficient of interest is going to be this triple difference coefficient. It's going to be a dummy for post NZBA. So this dummy is going to equal 1 after bank B joins the NZBA alliance. It's going to be 0 before the bank joins the alliance, and it's going to be 0 if the bank never joins the alliance. And then we're going to have a second interaction with some measure of the brownness or the greenness of the firm. So the first dummy is going to be the simple dummy of whether or not that firm is in the mining sector. The second is going to be whether that firm is in one of the bank's sectoral targets. So if Deutsche Bank has a target in oil and gas, this will be one for oil and gas firms. The last is going to be whether that firm is in the EU taxonomy. And we're going to have a bunch of bank level controls in some specifications. So the interpretation of this triple differences coefficient is going to be the actual difference between two diff and diff coefficients. So you can think about it, if we take the simple example of whether the firm is in the mining sector, we're going to look at the effect of joining NZBA for mining firms relative to the effect of joining NZBA for non-mining firms. So there's what happens to brown firms, and there's what happens to non-brown firms after the bank joins the NZBA. And the triple difference is going to look at the difference between the two. So I'm going to go into this now in a little bit more detail. So the question is there a true credit supply reduction by NZBA banks to brown borrowers? So to think about the triple differences design, I'm going to go through the stylized example. So suppose we have two banks, net zero banks and regular banks, and we have two borrowers, a brown borrower and a placebo borrower. And there's just two simple periods before the NZBA alliance and after the NZBA alliance. So what am I doing if I'm comparing the total amount lent by net zero banks to brown borrowers in the post period minus the pre-period? So this is like those naive compliance regressions I showed earlier. I'm looking at the difference in lending. And that's going to be a combination of two things. There's going to be a credit supply effect. So maybe net zero banks are changing the amount of credit supply they're offering. But there's, of course, also a credit demand effect. There may be changes over time in the amount of credit that brown borrowers need. So obviously, in order for the simple naive regression to identify supply effect, we of course will need to assume that there's no changes in credit demand over time. This is not an identifying assumption we're comfortable making. So now let's look at the second diff and diff. So now what if I look at the difference in lending by net zero banks relative to other banks and just look at their lending to brown firms, right? Here, I'm now taking out the sort of changes in credit supply from regular banks and changes in credit demand from regular banks. But what is the identifying assumption I need here? I need to assume that demand shocks from regular banks are the same as demand shocks from net zero banks. So as I showed you earlier, there's this huge issue where the net zero banks are selected. I don't know if we can really assume that credit demand shocks from Deutsche Bank are the same as credit demand shocks from a random German regional lender. That's what we would have to assume for the simple diff and diff to work. So instead of the diff and diff, we're going to use a triple difference. So here we're going to look at the difference between lending by net zero banks we're going to look at the first difference, which is lending by net zero banks to brown borrowers relative to regular banks lending to brown borrowers. But we're going to also have this additional difference from a placebo group. And we're going to look at the difference in lending by net zero banks to the placebo group relative to the regular banks to that placebo group. So the idea of the triple difference is I can absorb any demand shocks happening to Deutsche Bank relative to the regional lender by looking at demand shocks from this placebo group. So the identifying.
One question. What is your definition of the placebo group?
So it's the placebo group here is going to be for those dummies. So sorry. So the placebo group here is going to be whenever whatever the interaction term is zero. So if I'm looking at the effect of mining, the placebo group will be non-mining. If I'm looking at the effect of sectoral targets, the placebo group will be non-sectoral targets. If I'm looking at the EU taxonomy, the placebo group will be non-EU taxonomy.
Thanks, that's a very helpful clarification.
Yeah, of course. And so that's how we're going to try to think about absorbing these demand shocks. So what are the concrete identifying assumptions we are allowed to make? So this identification strategy will allow there to be differential credit demand shocks by bank. It will not allow for differential credit demand shocks by bank borrower. So that's the key. There cannot be a special shock for oil and gas firms borrowing from Deutsche banks that's different from their demand shock for a regular bank. That's the idea here. All right. And another way to think about it is that there's a parallel trends assumption in ratios rather than in levels. We show this in the paper. All right, so that's the identification strategy. So now I'll talk about our results on divestment. So here we're using the FinRep data. So instead of having firm level data, this is sectoral level data, but we're going to have bank sector, sector time, and bank time fixed effects. And using this, we can see that we can reject any divestment at the global scale that exceeds 37 basis points. So in other words, net zero banks are not divesting relative to non-net zero banks by more than 37 basis points. So we say that there's basically no divestment happening, and this is a really precisely estimated null result. This null result goes through even when we look at the PPML, which looks at levels of lending rather than portfolio shares. So there's no divestment happening in banks' global portfolios from mining firms. And then we're going to look at the on a credit data. We're going to look at the intensive margin. So we're going to limit this data set to bank firm lending relationships that persist throughout the whole sample. And we'll look at whether credit is reallocated from one borrower to another. And then we'll also look at the extensive margin. So are they entering into new relationships or exiting from existing relationships? And so here, if you look at the intensive margin, we're seeing that they are not divesting from mining firms. They're not divesting from their sectoral targets, and they're not scaling up to the EU taxonomy. So if you look at the sectoral targets in particular, you can see that we can reject any divestment that exceeds 2.7% percentage points. Sorry, percent. And so we can reject even moderate sizes of divestment using this specification. This is also going to hold for pricing. So we don't see any significant changes in interest rates for mining firms, for the firms in the targeted sectors, or the firms in the EU taxonomy. So for the targeted sectors in particular, we can reject any increase in interest rates that exceeds 5 basis points. And if you compare this to the baseline average, the average interest rate is about 2.4%. So now if we're looking at the extensive margin, we now look at whether banks are more likely to exit from relationships in the mining sector or the targeted sector or the EU taxonomy. So we see on average, this is a positive coefficient, but we don't really see significant changes. We don't see large scale exit happening from the mining firms. We actually do see a moderately significant increase in exit from the targeted sectors. So they are likely to exit by 87 basis points more. We see no real significant change for the EU taxonomy. So someone could look at this and say this is some marginal evidence of divestment. However, the results on entry dwarf the results on exit. So we also see that they're more likely to enter into new lending relationships with firms in the targeted sectors. And this result of a 3 percentage point increase in entry dwarfs our 87 basis point estimate of exit. So on net, we're seeing net zero banks are more likely to enter into new relationships with firms in their sectoral targets. So this is strong evidence against divestment on the extensive margin. And then finally, all of the evidence I've shown so far has been sort of looking between sectors or between sectors. We're now going to look within sectors. So we're going to look at project finance lending to power generation firms. So this is the newest part of the paper, and it's the one I'm most excited about because normally we don't know what financing is being used for. So if a bank is lending to Exxon, maybe Exxon is installing a solar panel, right? And it may be good for the environment, even though it sort of would be classified as a brown loan. So here what we're doing is we're looking at project finance. Project finance is unique in that a new legal entity is created for the purposes of installing a single generating asset. And so we're actually able to know what the proceeds are being used for in project finance. And so we can look at these companies, we can see if they are renewables companies or not, and we can see if these NCBA banks are actually more likely to do project finance loans for renewables. And we can compare it to project finance loans for other types of power generation, like coal. So using this green project finance data, we see that there is no significant scale up of project finance. This is looking at the share of all project finance going to renewables, the level of financing going to renewables, as well as the overall amount of project financing. And if you actually look at who's doing the most project financing in the data, we have this chart in the paper, the non-NCBA banks are doing way more project finance for renewables than the NCBA banks. Even though the NCBA banks are the biggest global banks in the world, they are a minority player in the project finance space. So we use this evidence to show that they're not really scaling up their green project finance, which is the primary form of financing that's used by renewables power generators. So that's all our results on divestment. Now I'm going to talk about our results on engagement. So The idea here is we want to know, maybe banks don't want to divest, maybe they want to leverage the power that they have from the relationship to sort of change the operations of the firms that they're lending to. So the idea here is, do borrowers that are heavily dependent on net zero banks for their financing, are they more likely to do things that we can observe which suggest that they're changing their strategy? So a natural way to look at this is whether the borrower has set its own decarbonization target, because setting a target is often the first step to actually decarbonizing. So here we're going to look at if a particular firm has made a decarbonization target through the Science Based Targets Initiative. We can look at other target setting too. SBTI is just the one that seems most used by firms. And we're going to link each borrower to its primary lender. So we're going to do this in a few different ways. We have some robustness. The results I'm going to show you today is just at the beginning of our sample, which bank lends the most to that firm. And post NZBA is going to equal 1. After that primary lender joined the NZBA, it's going to be 0 before, and it's going to be 0 if your primary lender never joined the NZBA. And we're going to also look at our additional interactions, so not just the post dummy, but whether that firm is in the bank sectoral target, whether that firm is in the mining sector, or whether that firm is in the EU taxonomy. And so across the board, we find even if they're significant in the first couple columns, the magnitude is extremely small. So we see very little evidence. Actually, we see, if anything, that borrowers connected to an NZBA bank are 1 basis point less likely to set their own target. And of course, when we look at the triple difference, we see almost no effect at all. And these are extremely precise confidence intervals. So we can reject at the 95% level that firms in the mining sector or the sectoral targets are more likely to set their own decarbonization target because their bank is forcing them to. That's the idea here. This result is looking at actual emissions. So a subset of firms in the European Union are subject to the European emissions trading scheme. So we have verified emissions data for some subset of firms that are subject to the EU ETS. So we use the EU ETS data and we bring it into our bank firm credit registry, and we see whether their verified emissions change. So the confidence intervals here are a bit bigger because we don't have as many firms which consistently report their carbon emissions. But even here, we don't really see significant evidence that borrowers that are connected to an NZBA bank are significantly reducing their carbon emissions. So this is more suggestive evidence, but here, we don't see significant changes in verified emissions. So now I'm going to just kind of put all of our results together. So to conclude, we're using these new administrative data sets to explore whether these voluntary net zero commitments are leading to changes in lender behavior. And contrary to some other studies that have looked at a similar topic, we're finding no evidence of systematic divestment. We're also finding limited evidence of engagement. This suggests that a lot of the results found in the other papers are likely driven by credit demand shocks and are not actually affirmative reductions in credit supply from the banks. Our takeaway from this is we're a bit skeptical, maybe even some might accuse us of being cynical, of the value of these voluntary commitments in the financial sector, because these voluntary commitments, we don't think the evidence shows that there are these non-pecuniary preferences towards decarbonizing investments coming from the financial sector. Seems like everything that we're seeing is being driven by changes in credit demand. And a lot of our results are supportive of recent efforts by the European Central Bank and by entities in the United States to improve the credibility around these lender net zero commitments. But of course, we're going to caveat our results. Perhaps it's too early to tell. Maybe we will see in 2030 or 2050 significant changes coming from the net zero banks. So Emil, David, and I, and I'm sure many others, will continue to update these results to see if we're seeing those changes in the future. Thank you so much. I will stop here and maybe I'll leave open for if anyone has any questions.
Thank you so much, Pari, for your very insightful presentation. So indeed, if anyone wants to ask a question, please raise your hand and I will mention your name and you can read out your question. Alternatively, you can put your question in the Q&A box and then I can ask the question on your behalf. Maybe before I turn to the audience, Perry, I can perhaps ask you a few sort of broader background questions of your paper.
Absolutely.
So the first one is you have looked at the actual targets that the banks that have joined the NZ Alliance have set.
Mhm.
Have you been able to sort of plot, if they were to live up to those targets, what that would mean for their emission reductions over time?
Mhm.
And so that's, I guess, question number one. Question number two is, you're saying that so far there's not evidence to support either divestment or, engagement or
Mhm.
action through engagement.
Mhm.
Uh, um, Sort of, do you think that so basically, do you think that maybe because the earliest target, I guess, that the banks have set is 2030, that they're sort of just holding off a few more years, and they may, later align their portfolio with their
Mhm.
2030 targets? So, do you have some
Yeah.
type of idea of how they may in the end catch up with their targets? And
Mhm.
yeah, let me stop there and give you
Sure.
a chance to respond.
I can start with those two, and then I'm sure we can continue on. So on the first point, this is sort of a little bit about benchmarking, like the ambition of the targets and where they are relative to that ambition, in some sense. And it's a bit so we really wanted to do something like this. It's a bit hard to do because the actual targets are in units of scope 1, 2, or 3 emissions, and it's a reduction in financed emissions. And without having universal reporting by all firms on their scope 1, 2, or 3 emissions, we felt like it wasn't, I don't, maybe the banks have access to this data, but certainly in terms of the publicly available data, we just couldn't do it. You can only get, for EU ETS emissions data, you only get it for a subset of firms. And then for everyone else, you have to rely on voluntarily reported emissions. And then that introduces a whole host of issues. And so we decided to just start with, what if they entirely met their emissions reductions targets through financing, like part one, rather than the emissions? And that we have done a benchmarking exercise like that, but we haven't actually done the true benchmarking of where they are relative to their targets because of the data issues. But in some sense, I don't even know how the banks can do it unless they get these data from every firm borrower. I don't know how they can even make a credible claim that they're on track for their own targets. So it's a bit of a, yeah, it's an interesting question. And then your second, oh, sorry.
No, please, please.
No, I think so. Your second question, I think was about the timing, like, these targets are for 2030. Could they catch up? So I mean, in principle, they could. We are a bit skeptical because the average life cycle of a renewables project, it takes like 5 or 6 years from the time the project is financed to when the renewables project comes live. And so we feel like if you want something to be up by 2030, it's going to have to happen in the next year or two. So that's why we're not sure. We are skeptical of them meeting their 2030 target. They could very well meet their 2050 targets. So we'll, yeah. Mhm.
Sure, that's really helpful. So one more question, and then I'll turn to the audience. So you show that banks that sign up to the net zero target reduce their lending to sort of mining sector, I believe, by about 20%.
Yes,
So but you say that that's not different than those that did not sign up to
exactly,
the net zero target. Do
exactly.
they increase their lending in other sectors? So where, or do they just in general reduce their portfolios? And if so,
Right.
other sectors do they increase their lending?
That's right. So that's true that so I'll nuance it a little bit. So it is true that they're reducing their lending to mining. They are increasing their lending. That sort of definitionally implies that they must be increasing portfolio shares to non-mining. And we haven't really looked at the source of that growth. It's true. That would be interesting to know, like, who's benefiting from that. I think the bigger point though is that if you look globally, they're not reducing their portfolio shares of lending to mining outside of the US and Europe. And
Hmm.
so I think like the point that we're trying to make there is the US and Europe are closing down coal as kind of a matter of policy,
Right.
or maybe because renewables are cheaper in the US and Europe. So there's just this natural movement away from coal. And the lenders are going to take credit for that when they give their progress report, right?
Right.
They are reducing financing, but we think it's entirely being driven by credit demand because we don't see that happening in their global portfolio.
Right. Yes, that's very logical. Thank
Yeah.
you.
Mhm.
All right, so let me open up the floor to the audience. So feel free to raise your hand or post a question in the chat.
So there were two in the chat. I'll just maybe mention them in case they are questions that other people have. A couple of people asked if we've looked at other alliances like the SBTI that banks could join. And the answer is yes, we actually have looked at a number of alliances, but the reality is that the majority of the banks that are in the NZBA are also in these other alliances. So we don't get that many additional banks from looking at these other alliances. So we can't look at, like, one of the things we wanted to look at is, are there good alliances and bad alliances? We don't really have the power to say anything on those lines since it's just the same group of banks in every alliance.
So I think there's one other question. So have you run similar analysis for banks, FIs with an SBA validated target? Do the results differ in terms of outcome in engagement or divestment strategies?
Sorry, which one is which alliance was
By Guillaume Bone, do you see the question?
Oh, yes. So this was what I was just talking about. SBTI, we've looked at UN Global Compact, we've looked at the Equator Principles. We have like the spreadsheet and it's always the same group of banks. NCOA, we don't think is as relevant because these guys they're making their NZBA goals about bank financing. So Net Zero Asset Owners Alliance will be relevant to the bank securities portfolios. So if we had data on bank securities portfolios, we think that will be the relevant alliance, but we don't think it's relevant for this. CDP is also not really relevant. CDP is whether the banks are asking for firms to disclose carbon emissions. I don't know, maybe you guys will push me, but I feel like it's always like, what about this alliance? What about that alliance? What about this? And it's just like the Net Zero Banking Alliance, they've said we're going to reduce finance emissions in these sectors. It's the most specific thing you could ever evaluate. So the idea that they're not doing it when they're being so specific, but they are doing it in some vague commitment that they've made in some other alliance, for me just feels like very unlikely. I'm sure all of you will push me on this, so I understand the questions, but that's kind of our take on this.
Sure, thank you. So there's a question by Teresa Gecko, if I pronounce that correctly. Teresa, do you want to ask your question? Teresa, we don't hear you. You might have to unmute.
Maybe let me stop sharing. Okay.
So I'm not sure if Teresa is still here.
Oh
Teresa,
no, she said she wants to unmute in the chat, but she can't figure out how to unmute. Maybe we can unmute her.
or you can ask your so Teresa, alternatively, you could ask your question in the chat. Is that the question you already asked, or do you have another question?
Is it working now?
Oh, yes.
Yes, we can hear you.
Very good. I think I cannot turn on my camera, but it should be fine like this. I just have an additional question on SBTI because I mean I'm from WWF and you might know that we're collaborating with SBTI. So for us it would be really interesting to have specific like results on SBTI. And I do understand that some of the banks do have both targets, but I think there must be some other banks that only have SBTI, and it would be really interesting for us to see the results from SBTI.
It's only three banks that only have, in our sample, it's only 3 banks that only have SBTI.
Okay. Yeah, because I mean, okay, so you and these 3 banks, you mean it's
There's no effect if you add those
2.
3. Yeah. If you add those 3 banks, our results go through. Yeah, I'm sorry.
No,
I
I mean it's also good to know that that you see no effect. I mean that's also a result that we have to live with, and we have to understand if that's the result that you're getting. Then it's also interesting to see what we're doing with this kind of result.
yeah, I mean, I feel
Because
like
SBTI is quite specific, and I think they have 5-year targets. So I'm a bit wary. I think Net Zero Banking Alliance is a bit less specific than SBTI, so we are expecting that the results would be a bit better.
it might be, and it may be, I don't know, it may, like, there's still, you know, we're looking at administrative data on lending by European banks to European firms. Europe is already a place with a carbon tax, like, or whatever, carbon price, where renewables are already more profitable than coal, right? And so the fact that we are seeing decline, we are seeing a scale up in overall financing for green renewables, and we're seeing an overall decline in financing for coal. But what this means is that in places outside of Europe, where those trends are not the same. In India, for example, coal is still way more profitable than in Europe, right? And what our paper is saying is that Commerzbank is not going to go to India and say, no, we're not going to finance coal in India because of our net zero commitment or because of our SBTI commitment. And I think the question is whether we want them to. If the Net Zero Banking Alliance is not or the SBTI does not require turning down profitable opportunities. That's not a requirement, right? And so I think we have to be just asking them to show their overall financing volumes is not going to give us the answers that we want. I think that's like one of the points of the paper. The stuff that they disclose is going to look very good because of the US and Europe sort of tainting the sample, if that makes sense.
I do understand. Yeah.
Yeah.
Yeah, I mean, if you could add something about like your recommendations or your results for other initiatives in your paper, I think it would be really interesting for us to discuss
That's a
this
great
further. Yeah, so that we have it, like, you know, because when you write it down, like when we have it written down, it's easier for us to discuss this further.
Sure. Yeah, we can definitely do that. It's hard. We're ducking it to you guys, but we can definitely try to give some more color on policy recommendations.
Thank you.
All right. Are there any other questions from the audience? So I think there's a question from Martin Sokol. Was your paper published yet? If so, could you share the reference, please? I think it's currently a working paper. Is that correct, Pari?
Yes, exactly. So I just put a link to the SSRN working paper.
Great. Any other questions? All right. Well, then I again want to thank you so much, Pari, for your very interesting presentation of your research. I think it's a very important topic. So thank you. To the audience, our next webinar will take place on Monday, April 11th at the same time, 11 a.m. Eastern. And in this case, Hyeong Jung from the Federal Reserve Bank of New York will talk about her research on US banks' exposure to climate transition risks. And you can register for this webinar at the eAccess website. So thank you again, Pari, and see you hopefully in 2 weeks' time. Take care.
Thank
Bye.
you.
Bye, everyone. Thanks so much.